Hello my people, so today we're going to go through the opening range model. We're going to go through this quite quickly and just give you all the criteria for the setup and then for the entry. In this example we're using the opening range gap as a point of interest rather than a draw on liquidity, but we will touch on it being used as a draw on liquidity as well in future lessons. So as we can see, we have our setup criteria. We need to first define the range, which we can see we have our range extreme low here from yesterday's closing price, and then our range extreme high here on the current day's Asian session. We can see that from here we've traded lower and then we've started trading higher. We have our midnight open here, and as we trade below it we're in a discount. As we trade above it we're in a premium on the daily range. So then comes in criteria number 2, pair orders at a fair value. So when we're up here and we have 930's opening candle here, what it is doing is it is dropping to 1 pair orders with sell side liquidity, as we must take sell side liquidity and stop our retail longs before actually sending price higher, which has all been touched on in my core content playlist that you can have a look on for free on my YouTube. And the other portion of this is at fair value, meaning that when we're up here in a premium above the midnight open, we need to drop below the midnight open and to a discount of this range higher, which we can see I have added here and is established right there. So below the midnight open and below the equilibrium point, we're looking for stop losses to be taken to pair orders at a fair value. Then moving on to the third part of the criteria, we need the opening range gap support. So if you're wondering what these big thick lines here with 0, 25, 50, 75 and 100%, this is delineating the opening range gap from yesterday's closing price to today's 9:30 a.m. opening price. If we look here really quickly on the regular trading hour chart, where I just went into the bottom left of my screen next to the time and changed it from ETH to RTH, and we can see that this candle was a bearish close on yesterday's close, which means it closed here, and today's opened all the way up here. So from this low to this high, yesterday's close to the opening bell at 9:30's open, this we can measure a fib across, a Fibonacci retracement, and we can, if we just go back to the electronic trading hours here, we can see that we will get these levels here, and we want to look for these levels to support price going higher. So if we look at what transposes, I had this minor sell side delineated because I wasn't sure if we were going to use the 50% or the 75% level, but I also had the London low delineated at the time, as I believed that we could reach down here, as we clearly have done. We've created a swing low with these 3 candles, and just look at how these wicks are rejecting this lower quadrant 75% level, and the bodies are closing above it. This is telling us a story that with pairing the orders for the London low, that this might be as far as it wants to go before it's ready to reverse. So from here we can drop in to the lower time frames and start looking for our entry mechanisms or our entry criteria. Now on the 1 minute time frame, we can see that we have our 9:30 open here, and I've also delineated our 10:30 open with 2 vertical lines, and that is because within this first hour of trading from the opening bell, there is usually a 70% chance that price will come into at least the upper quadrant or midpoint of the opening range gap that is created that day. See, that's exactly what transposed here. At 10:17 we swept the London low, we used the 75% level, quadrant level of the opening range as support, and then right here as we get into this next macro, we have this change in the state of delivery as we shift above this market structure, creating this fair value gap, and we can use that as our entry mechanism. Okay, so as I've written here, change in the state of delivery. This is after all the criteria for the setup that I just mentioned on the higher time frames as all transposed. Then once we drop into the lower time frames, we look for a change in the state of delivery, which happens here. Okay, with the shift above this market structure after we swept this low. We look for it to be around our macro time from 1050 to 1110, because this is when price is going to either create highs or lows or expand. And then we look for our entry mechanism, which is quite simply just our PD array. Okay, so here it gave us a fair value gap, and this is what I would have used for entry. Now, this is for the more advanced understanding of this model, when we're just kind of using market maker models and you just know the PDA matrix. But here is for the more conservative people with this model, if you want to get an entry criteria. So I know I've made it a little bit confusing that I've done two separate first presented to fair value gaps here, but realistically you could have used either, or it doesn't highlight a massive difference here. The reason I have put 930s here is because if we go back on the regular trading hour chart, we can see that the 930 open, which opened right here at this 0% line, has opened above this liquidity on the regular trading hour chart. So that means that we can actually use the 930 fair value gap as our first presented fair value gap. But that is the only time we would use the 9:30 a.m. candle as our first presented fair value gap. Beyond that rule, we would be looking for any fair value gap after 9:31. Now you might be wondering, well, 9:31 and onwards, but you might be wondering why not use this gap here then? And that is simply because this gap is only 6.75 handles and is not the 10 handle minimum. That is a rule that we like to look for these. So if we go then look at the 933 fair value gap, it is 21.75 handles and does qualify for a potential first presented fair value gap. So it really didn't matter either one of these which you choose. I'm going to actually show you examples quickly for both of them, because let's say that you don't feel confident entering down here. This is a bit too advanced for you to begin with and you want to work up to this. Well, you can wait for a first presented fair value gap, okay? Or ideally you would just have one. As I said, I'm just showcasing both. But you would just have your first presented fair value gap. You would look for it to be traded above and used as support. That would be used as our change in the state of delivery, and then we would look for a macro time to then have an entry mechanism. So for example, we swept the liquidity here, we traded above the first presented fair value gap again, traded back into it. We are in a macro time. You could have entered inside this fair value gap, put your stop loss here, but you would have had to sit through a bit of this chop until the next macro comes along. As we're heading into the PM session, we sweep this liquidity into this order block, and then we have this clear displacement above this first presented fair value gap, and then you could have entered upon this candle retouching that 25% level. You could continue to pyramid here and enter as we trade above this order block and back into it, and then you could have even used the next first presented fair value gap as we traded above it and then created this fair value gap and started using it as support. Could have entered in here if you wanted to wait for the macro. As we created this next fair value gap, you could have entered in here, put your stop loss down here, and then this would be the low hanging fruit objective, and the Asia high would be the terminus for that trade. So really lots of things you can do with the entry. It really mainly all comes down to the setup, and that's the real nuts and bolts of this model, and most models, to be honest. So anyway, I hope you found value in that. I'll speak to you in the next one. Ciao.